There are many face-offs in investing: active versus passive, debt versus equities, mutual fund versus stocks, regular plans, direct plans, bulls, bears, and of course there is growth investing and value investing. Growth and value represent the two dominant styles of investing, and every investor often has a preference or leans on one of these styles. To put it broadly, growth investing is the fast and furious approach. It is built on identifying companies that have the potential to outgrow its competition in terms of revenue and profits, which then translates to a jump in the stock prices. When we look at value investing, we are looking at a much slower but steadier approach which seeks to buy companies that are trading at a price that is lower than what they are actually worth. The premise here is that those companies are undervalued and eventually the stock price will correct itself, paving the way for handsome returns. In this video, we shall go deeper into these two styles as we understand their differences from the perspective of their objectives, valuation metrics, and performance. Where possible, we'll elaborate with some specific examples, and if you learn something new today, then do tap on to that like button and share your observations in the comments box below. Let's begin. Growth investing's assertion is rather simple. If the sales or EBITDA or earnings per share of a company is growing at an above average rate, then the stock price is likely to follow that same trajectory sooner rather than later. These companies may be young, in an emerging field, and probably have the potential to dominate their field, a bit like finding the next Google, Facebook, or Amazon. And while there are visible upsides, investing in growth companies also come with some additional risk, which makes these stocks pretty volatile. But risk is not really what the growth investor looks for. And more often than not, stocks in these companies are invested into without any history to support the prevailing growth premise. Take Zomato for instance, and let's ask ourselves some questions. Is Zomato's business growing? Yes, it is. Is it presently profitable? Absolutely not. Does Zomato pay a dividend to its shareholders? No, it does not. Is Zomato likely to get bigger, stronger, and more profitable? Well, we really don't know the answer to that, but this is exactly what the growth investor is counting on. Now, growth can be a function of many factors, and as an investor, one needs to pay a lot of attention to that. For instance, is this growth due to an improvement in product or strategy, or is it on account of an acquisition that the company has recently made, or is it merely the good fortune that the company or the sector has recently had? For example, in 2017 and 2018, the price of graphite electrodes had risen sharply by 8 to 9 times. Now, these were favorable tailwinds for the graphite electrode industry, which saw one of its leading companies, HEG Limited, putting up an impressive showing in terms of revenue and profits. But then the growth was short-lived once the price of those electrodes went back to its long-term mean. The point is that investors have to carefully factor things like cyclicity or inorganic growth when identifying growth companies for suitable investments. Now, when it comes to the value investing approach, the attention pans almost entirely to the opposite direction. For one, a value investor is not really looking for those flashy companies that are breaking records or are promising to change the world. In other words, no Facebook, no Netflix, no Zomato. Instead, these investors are more keen to put their money behind the more boring but established, predictable companies in more mature industries. To put it differently, the value investor is a bargain hunter and loves preying on stocks that are priced at a 30, 40, or 50% discount to their true worth or intrinsic value. And to identify such companies, the value investor employs a number of techniques, which even includes putting money into companies that are declining or even bankrupt companies if they believe that the liquidation process will get them more money than what they had originally invested. So in effect, value investing is based on what's presently available, while growth investing, a lot like what we saw with Zomato, is looking more into what a business might be in the future. And speaking of Zomato and its growing food delivery business, another growing superstar that has been delivering delicious videos every week is the ETMONEY YouTube channel. So if you haven't subscribed to our channel or invited your friends to join our growing community, then kindly do so as we continue to grow our repository of videos on investing and personal finance. A value investor's interest in determining the right price to pay for a stock should come as no surprise. They are bargain hunters and are keen to try different approaches to understand the true worth or the intrinsic value of a stock. Now, one of the most basic valuation techniques used by value investors and even by everyday investors is to look at the price-earning ratio or the PE multiple of the stock. A price-earning ratio is nothing but the number we get when we divide the price of a stock with its earnings per share. To put it differently, the PE ratio gives us the price we need to pay for 1 rupee of profit. Now, since a large meatier part of the earnings is to come in the future, growth stocks generally have a high PE ratio while value stocks tend to have a low PE ratio. In fact, if you'd like more information on how the PE ratio works and how an investor can take the maximum advantage, I truly recommend our video on the PE ratio, whose link has been attached in the description of this video. In addition to the PE ratio, there are many other metrics that show contrasting characteristics. For instance, growth stocks command a higher price when compared to their earnings, their book value, or their operational cash flows. And likewise, companies of value-oriented stocks offer a higher dividend payout and a higher dividend yield as compared to growth companies. So here's what it comes down to. Growth stocks are more expensive. They have high, sometimes very high PE ratio, PB ratio, which is all driven by the future potential that these stocks carry. These are the apple of the stock market's eye. In fact, let's look at Apple, the company. In December of 2007, the Apple stock was at an all-time high PE of almost 40 as against the then long-term PE ratio of about 18. This might seem expensive, but then Apple had the newly introduced iPhone and there were many investors who believed in the company's growth prospects. And since then, the company has done extremely well on most counts, and that investor who picked up that Apple share for $6 in 2007 would have made an annualized return of 25% over these last 14 years. And that's how growth investing works. The stock that seemed very expensive at that time is now looking much like a bargain for the growth investor. Comparing the performance of growth and value stocks is a favorite topic of discussion in business channels and podcasts. And in the last few years, there have been a lot of chatter on the possible demise of value investing. But the truth of the matter is that both the growth cycle and the value cycle takes turns in outperforming and underperforming the market. To substantiate this, we looked at two very popular indices pertaining to the US stock market, the Russell 1000 Growth Index and the Russell 1000 Value Index. These indices were tracked since 1979 onwards, so a good 4 decades of data was taken, and what came out is that both these indices have given almost identical returns over the last 41 years, with growth giving 12.1% returns and the value index delivering 12.0%. But while the numbers are similar, the path to reach these returns for these two indices has been completely different. The growth index had its best years between 1989 and 1999, and then again between 2009 and 2020 when it clocked over 20% of annual returns. Likewise, value stocks fared a lot better than growth stocks between 1979 and 1988, and again between the years 2000 and 2008. So there is some pattern that's emerging here which seems to show that growth and value preferences change every 10 years or so. Even when we see the data in shorter cycles, say using a 3-year rolling return, we kind of see how growth and value stocks go through a meandering journey of relative overperformance and underperformance to each other. As we see here, the gap in returns is pretty wide between the two investing strategies. And what's interesting to observe are the precise moments when the growth story turns to value and the value story goes back to growth. Notice here that when the stock markets find themselves in a major and turbulent time, there is a tendency for the market participants to switch from one strategy to the other. We see this in 1987 when the US stock markets fell by over 20% on a single day. Then in 1992 with the bursting of a super inflated Japanese property market. Then the dot-com bubble in the early 2000s and the global financial crisis in 2008. Having said this, it will be interesting to see in which directions the wind are moving now on account of the 2020 COVID pandemic. Now, the analysis we have done here is on the US markets, and while we wanted to have something similar for the Indian stock markets as well, we couldn't find enough data to make a concrete assessment of how growth and value stocks have operated over the last few decades in our country. But if we do find something, we'll be sure to have a follow-up to this video. Growth and value investing represents two different styles of investing with their unique set of opportunities, objectives, companies, measurements, and drawbacks. When it comes to investing, an investor has three options to choose from. Option 1, you can pick either of the two styles and stick with it. Option 2, you can try picking out the style which is likely to outperform at a given time. After all, both approaches do go through some periods of dominance and weakness. And then we have option 3, wherein an investor can own some growth stocks and also some value stocks. In our opinion, and is always the case with choices, none of the three options is like perfect. With option 1, you need luck on your side as one doesn't know how long these cycles will last. With option 2, and while it sounds terrific, timing the markets is excruciatingly difficult. And option 3 would mean holding some outperforming stocks and also holding some underperforming ones. But there is no denying that growth investing and value investing in isolation is not what professional investors prefer. Instead, they seek out hybrid strategies that look to apply the best characteristics from each approach. For example, GARP, which when expanded comes to growth at a reasonable price, is a much practiced investment approach that seeks to balance pure growth and pure valuation. Under this approach, investors look to invest in growing companies with solid fundamentals that are not too expensive. These companies invariably turn out to be excellent investment vehicles that can offer a 10x to 100x returns in a few short years. It looks simple, but is definitely not easy, and that's why many successful investors don't mind admitting to the fact that good investment requires three ingredients: a little bit of luck, a fair amount of skill, and a lot of discipline. And with this, we come to the end of this presentation. I sincerely hope you have found some of the material shared in this video helpful, and we sincerely hope you can build upon these nuggets of information. If you have any questions, any feedback, then do type them in the comments box below. Once again, thank you for your time. Do subscribe to the channel. Do like this video, share it with your friends, and I look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.